So I'm sure you enjoyed quite a lot. You enjoyed quite a lot on what we discussed in our first session. I appreciate it was so technical. I need to acknowledge that. But when we then did questions, I'm sure you were now saying, what was the fuss about? Currents, futures, options. It appears the hedge setup just zeros to just 3 or 4 lines, and you have your answer. But to get there, there's a lot of technical stuff involved. And you realized also that concerning that topic, examiners also are fond, they like some discursive aspects. And I pointed out to you that they are a major source of easy marks. You realized how we were getting easy marks. And clearly, I don't expect you to understand this past video and this video in a single lecture. You need to play it whenever you are thinking of derivatives, you are thinking of what these are the videos you have to be playing, plus the other ones I'm going to send containing explanations of other past exam questions. Okay, now let us take it a little bit further. Let us now discuss how to hedge interest rate risk. Now, hedging interest rate risk, we need to get these things clear. Number one, it has nothing to do with foreign currency. You are hedging interest rate. So you can hedge interest rate in your currency, unless perhaps you are taking out a foreign loan. But what we want to zero it into interest rate risk. That's another thing. Another thing concerning interest rate risk is what is meant by exposure period for that particular interest rate risk. You are exposed to interest rate risk between now and the time you get the loan. Thereafter, what happens thereafter are cash flow consequences of what you did whilst you were exposed to the risk. If I want to take a loan on the 31st of December, the loan is for 2 years. I am exposed to interest rate risk between now and the 31st of December. What happens to the interest rate here can then affect the rate I will be charged on the loan. Thereafter, it's now contractual. There's nothing to worry more. It's now contract once you get the loan. So when we are calculating basis of interest rate risk, suppose we are using interest rate futures, we are calculating between now and the time we get the loan, not during the loan period. No. You know what? Actually, with that statement, that's all you need to know. Let us now again get us into the specific hedging techniques for the interest rate risk. Sharing my screen now. Right. So it's just a continuation from where we left. What is that? Okay. Just a continuation. Right. So interest rate risk, it affects the cash flows that the company will pay when it comes to interest. So what you do between now and the time you get the loan is important because it will determine the amount of interest that you are going to pay. There are various sources, there are various factors which cause loans to have this particular interest rate, but let us zero into the two main terms or clauses on interest rate. Interest rate can be fixed or interest rate can be variable. And if this now is coupled with the term of the loan, the risk is exacerbated. So if you have a fixed interest rate loan, you benefit if interest rates are increasing. But if interest rates are falling, you still pay the fixed rate. So in mitigation, some have variable rate loans. Variable rate loans, again, these are loans which interest rate is varying according to an index, be it LIBOR, it might be LIBOR plus 150 basis points. It might be, just to say, interbank rate plus 20 basis points. That would be the interest rate. So if you are a borrower and you have a variable rate loan and interest rates are falling, you benefit, but if interest rates are increasing, you lose. So you then need to have what is called an optimum debt portfolio. An optimum debt portfolio is a portfolio which now minimizes this overall interest rate exposure due to the characteristics of the loans that we have. Here are ways to hedge interest rate risk, and as you can see, they can be internal or external, like what we did in currency risk. For example, netting. Netting, we are taking of aggregating what you are paying against what you are going to receive. Interest you are paying, interest you are going to receive, and then hedge the net exposure. That's netting. Smoothing is like you want to maintain a balance between fixed rate and floating rate loan notes. Matching simply means if you are to borrow interest at 30% and 20%, you also need to lend money at the same rate. In so doing, you have matched. There is forward rate agreements, there is interest rate futures, interest rate options, and interest rate swaps. We are going to discuss this on the go. There is also pooling. Pooling is when you don't allow banks or subsidiaries or divisions to take out loans on their own, but rather what you do is by pooling, you have a head office which aggregates all assets of subsidiaries and arrange loan from a head office or bigger perspective so that it benefits from low interest rate. That's pooling, aggregating assets. If you join assets for all divisions and then arrange a common loan or loan on their behalf, you can bargain with a bank for a lower interest rate. That's called pooling. So let us now go step by step using forward rate agreements. Let us discuss this. How do you hedge interest rate when you're using forward rate agreements? This time it's not a forward exchange contract. You can see we are saying forward rate agreement. Right, I'm back to my Excel here. Remember, this stuff concerns mostly currents. So let us now say interest rate risk. Interest rate risk. Right. There are various ways, but let me start with FRAs, forward rate agreements. So the forward rate agreements, it's like you fix a rate with a bank for a future loan. You fix a rate with a bank for a future loan. If you are a lender, you can equally fix the rate for lending. If you are a borrower, you fix the rate for borrowing. Now, you always know that banks, there are various ways a bank can quote interest rate. A bank can quote interest rate like 5% to 10%, a 6% to 10%. If an interest rate is quoted like this, it means 6% is the interest on deposits. 6% is interest on deposits, and the bank is lending at 10%. So if you leave money in a bank, if you deposit money, it gives you interest of 6%. If it is lending, it gives you a 10%. This is important because when you are a borrower and interest rates are quoted like this, you need to know which rate are we talking about. So if a firm is a lender and the interest rates are quoted like this, it means the firm uses this rate here. That's if the firm is a lender. If the firm is a borrower, it uses this rate here. So you can be given this just like this by the examiner. You need to know the higher rate is for borrowers, the lower rate is for lenders. So from a banking perspective, so that one is fine. So a lender will go with the money to the bank and deposit it at 6%. A bank will lend money at 10%. So a FRA can be quoted like this. We can have a FRA like this, FRA of, we can have a FRA which says 3 to 9, some put 3V9 at 12%. So what this quotation means is we are going to take a 6-month loan in 3 months' time. 6-month loan in 3 months' time, and we are fixing a forward rate of 12%. This is forward quotation. So 3 is the period between now and the time you get the loan. The difference between 9 and 3 is the term or duration of the loan. And the 12% is the forward rate we are fixing, and this is per annum. So if you are calculating interest, you remember to say, in this case, times 6/12, because the 12% here is annualized rates. Actually, forward rates are annualized rates, so you have to scale them down to the duration of the loan. So there you go. So that's a forward. Now let us come back to the forward, which is saying FRA 3 to 9 at 10%. Let's say after 3 months, actual interest, which we call interest rate after 3 months, interest rate after 3 months. Let's say the interest rate after 3 months turns out to be 10%, and you were a borrower. These are the outcomes. Let's say the loan was $100 million loan, or the loan was 200 million. These are the outcomes from this particular forward. Outcomes. If you are a lender, I mean, if you are a borrower, what happens is you fix at a rate of 12%, but when 3 months come, after 3 months, the actual rate was 10%, so you didn't gain from borrowing. So as a borrower, you lose and pay the bank. You lose and pay the bank. This is amount you pay to the bank, 200 million times 12% minus 10%, close brackets, times 6/12. So you lose and pay the bank the difference. That's how the bank gains also, times 2% times 6/12, and this is 200 million. Oh, you lose 20. You lose 2 million actually. Yes, that's what you lose. So you pay the bank this amount, and clearly, if you were a lender, you benefit. The bank pays you. If you were a lender, because you had fixed that you shall lend money at 12%, and the actual interest rate turned out to be 10%, so you have benefited. The same amount is what the bank pays you if you are a lender. Now, what are the advantages of forwards? They are the same with the other advantages that we've been talking about. Forward contracts are binding. They are over-the-counter derivatives, and meaning they are flexible when we are negotiating them. They become binding once agreed. That one is still a continuing advantage. However, parties are still exposed to the risk of counterparty default. Imagine if I was a borrower and I had signed a forward that I will get a loan at 12% and interest rates turn out to be 10%. Will I still go to the bank to get that loan? If I then begin to neglect that obligation, it means I am now defaulting. You get that? So in the process, because of risk of counterparty default, forward contracts are closed out. Closed out. What do we mean by closing out a forward? Closing out a forward simply means If you were going to pay the bank 2,000, you get that money debited from your bank account. If you're going to receive 2,000, suppose you had benefited, you see the bank crediting you with 2 million. That process is called closing out. But as I have said, others may still default because they may still withdraw all the money before the bank debits. So it's still, the risk still remains. Okay, so that you understand. Let us proceed. All right. Oh, another point that I wanted to say is, when a bank, when you are fixing a forward rate with the bank, what you are actually fixing is the interbank rate, or LIBOR, or index rate, so to speak, the basis upon which all other interest rates are based. Like suppose we are fixing a forward like an interbank rate. It does not mean if I go to the bank today and say I want to borrow money in 3 months' time, but let us fix a forward. The bank will simply say interbank rate is so much. It is that which you fix in the forward. You don't fix the actual amount you borrow or lend money at. That one is company specific. It depends on the risks which are to do with that particular company, and no bank can assume that. What the bank can only agree with you is the interbank rate, because this is where this is their domain. So if you as a company, you borrow money at interbank rate plus 100 basis points, it means you go to the bank and fix the forward, the interbank rate. The 100 basis points, it's your baby. That one doesn't get hedged in a forward. Rather, you can use swap contracts and other stuff. The bank cannot say we are hedging your extra credit risk premium, the extra basis point. No, they say because your interest rate is interbank rate plus this, let us now hedge the interbank rate. This is what we need to fix in a forward. Right? So I told you how the forward rates work, and these are the obvious advantages. Now it's easy because we've already done this. Interest rate futures, as the same way we were discussing current futures, it's basically the same approach with interest rate futures. But there is terminology that there's something we need to know, notation. When you're talking of interest rate futures, what is important is notation. Interest rates. Interest rate futures. Let us discuss this. The first aspect on interest rate futures is notation. By notation, if we denote futures in a discount basis notation. Discount basis notation. So it will be like, suppose we are saying interest rate on the futures is 4%, we denote it as 96, meaning 100 minus 4. So if we say futures price is 96, we are simply saying interest rate quoted on the futures is 4%. That's what we are simply saying. So if we say futures price is 90, we are simply saying interest rate quoted on the futures is 10%. You say 100 minus the rate. That's notation. Another thing is basis. What we are referring to as basis now is the movement in interest rate. So suppose this is the future. You want to borrow in 3 months' time, and this is the futures price, 96. You now understand by futures price, we are now saying interest rate quoted on the futures. It's trading at 96. This is the futures price. And suppose the spot today was 7%. When you are calculating basis, you remember we say spot minus futures, but clearly you can't say 7% minus 96. It doesn't work that way. So what do you have to do to the 7%? The 7% you should write it again in discount basis notation, meaning you then have to say basis, it's now 100 minus 7. This is how we rewrite the 7%, and then you say minus 96. That's the basis. The difference between 93 and 96, which is 3. So it's important for you to know that basis, if we are saying discount basis, it means there is need for you to the computations that you come up with. Normally, care should be taken to make sure that are they given as interest rate or as discount basis, so that you compare them in equal terms. All right. The futures contracts are also marked to market daily, even if they are interest rate, because interest rate between now and 3 months can move in a favorable direction. You get profit. If they move in an adverse direction, you get you incur loss and you get your account debited. So all this is still the same, but this time what is being marked to market daily is the interest rate. What we mean by spot price in futures terminology, what we mean by spot, we are referring to current interbank rate, current inter, or let me remove the word current and say we are referring to interbank rate. Interbank rate slash LIBOR. If the examiner chooses to put the LIBOR, is still the same. That's what we are referring to as spot, right? And then continuing, how do you set up a futures hedge? It's the same. Like the basic procedure for setting up interest rate futures is similar to that for currency futures. So it's the same procedure, define the number of contracts and stuff, but this time it's no longer about currency. To say something is in pounds, is your contract size in pounds? No, this is in your currency. It's in dollars. So there's no need to say for that issue. But what I want to emphasize is to tone down your market position. Because when you get to the market, you need to assume a market position. I gave you an analog. Initially, I said, if you want to raise money with debentures, what do you do to the debentures? And you answered and say, we sell them. So if you are a borrower, you receive money by selling. You agree with me on that? No wonder why we are saying debentures, you sell them. Meaning, as a borrower, you receive money by selling. But now, look at it this way. If you are now hedging interest rate, being a borrower using interest rate futures, it's same terminology. You are going to pay interest rate, so you sell. You sell the futures contracts now. The same way we said when you are receiving current, this time you are receiving money. That's why you are a borrower. So you sell interest rate futures now and buy them later to close your market position. If you are a lender now, your market position is to you get to you lend money by buying. Clearly, you can't say I'm investing by selling. You invest by buying. Lending is a buying. So if you want to hedge interest rate, being a lender, you buy interest rate futures now and sell them later to close your market position. And you now understand what I mean by buying. These are market positions you take, and the brokers will calculate the contracts you are eligible to, or even the clearinghouse, and ask you to pay for the margin. So notice, borrowers sell futures contracts now and buy contracts later to close market position. This is so important. No wonder why the word sell is in caps. Even lenders buy interest rate futures now and sell them later to close the market position. Just follow yourself through. Don't worry. You get it. You get it. Then we look at how the outcome is computed. Have you noticed how we computed outcome on the forward? On the futures, it's a similar technique to getting the outcome, because what we are looking for is, because I have hedged banking on futures, if I'm a borrower, I sell now and buy later. So the price I sell comparing to the price I buy later, these two prices are hardly the same. So there's a profit element in this or a loss element in this. That becomes loss or gain from futures. So if I'm hedging interest rate for a loan I want to take in 3 months' time, what I have to acknowledge is that come 3 months, I need to know the spot on 3 months period. That spot, meaning the interest rate, come 3 months on the market, on the bonds market. It's not the same like on the futures that was quoted on the futures. When it's now 3 months, what I do is I borrow my loan at spot, but I then check how I close my futures to see if I've made profit on futures to adjust the loan I have borrowed at spot come 3 months. Let me repeat. If you fix a if you fix a forward contract, it does not mean when you are borrowing the loan, you borrow it forward. No. You borrow the loan at spot market. But if on the forward you had made a gain, the bank will pay you. Are you getting that point clear? You borrow at spot market, but you had hedged with a forward. So I can sign a forward agreement with NMB Bank and continue to borrow money at CBZ. I borrow money from CBZ at spot, but I then come to NMB Bank and say, now that is the day I am borrowing. Have I gained if I had not hedged? They then tell me, oh, we had fixed the forward rate of 6%, but the actual rate is 7%. So what I do, I get my loan at 7%, but the bank in which I had fixed the forward pays me the profit. Are you getting that? From the forward. You shall see how it works. I just want you to understand this part. No wonder why we say payment on the spot market. You still go to the spot, but you adjust it with gain or loss from the futures. Then effective interest is like it's like putting this on an annual trajectory, seeing how this outcome will be on an annualized basis. Because this will be, say, for 6 months, you then have to put it on annual rates, effective annual interest rate for comparisons. Now, if this effective annual, if you are receiving loan, if you are lending, you take the hedging option with the highest effective annual interest. If you are paying, you take the hedging option with the lowest effective annual rate. Then interest rate future options. It's so easy again, interest rate option. You are simply saying, what you are saying is, I now have a right but not an obligation to borrow at a specific rate. It's no longer an obligation, it's now a right. Meaning, come 3 months, if I see that the rate is not good, I just let the option lapse. But remember, there's a premium which is not refundable. I'm sure you understand that. There's a premium that you don't get refunded. Another thing is, premium on currencies was in cents, was in monetary terms when we are talking of currencies. Premium on options is in interest rate, because the interest rate is what we are hedging. You won't be given the premium as a currency, like sort of. That's one thing. Another thing is there's terminology used. Normally, borrowers are exposed when interest rate is projected to increase. So a borrower would hedge by setting a maximum interest rate so that if the spot market interest rate exceeds above, you exercise the option because the option rate becomes cheaper. That interest rate is called a cap. It's called, oh, look, I'm now touching on my cap. It's called a cap. So you can simplify it and say borrowers buy interest rate cap options. Interest rate cap options. And you will receive money. Always know that you will receive money by selling. So an interest rate cap is a put option because you are receiving the money. You receive when you are in a put. You know, put means undertaking to delete. Put means undertaking to deliver so that you will receive the money. That's put deliver so that you receive the put it there, so to speak, so that you receive the money. So if I'm a borrower, I deliver the contracts and get the money. So I buy put option, and in proper terminology, what I have bought is the cap. I have fixed the interest rate so that if the spot market interest rate increase above the cap, I exercise the option because it is now cheaper on the option. If you are a lender now, the thing changes. A lender is exposed when interest rates are falling. So lenders hedge against decrease in interest rates. And they set minimum rate, like the minimum, so that when interest rates are falling and they fall below this rate, they exercise the option. This rate is called a floor. So lenders buy interest rate floors. These are terminologies used, meaning minimum rate. So if the spot market rate falls below the floor or the option interest rate, the lender exercises the option and benefits. Now, there are businesses which are into lending and borrowing, like banks. Banks, they lend, they borrow at the same time. So they are hedging products when they are using options. They normally go by using a collar on options. They hedge using a collar on options. This collar now is between the cap and the floor. So they hedge against both interest rate increases and interest rate decreases because they are both borrowers and they are lenders. And it means actually buying a collar on options, it minimizes the overall cost of hedging to the firm. Why so? Because on the floor side, you are receiving the premium. On the call side, you are paying. So the premium you pay is the net. Because some you are receiving, others you are paying because it's a collar arrangement. In so doing, it reduces the overall cost of borrowing to the firm. Ideally, that's all you need concerning options. So if you look at it like this, I'm just, you know, an interest rate option grants the buyer of the option the right, but not an obligation, to deal at an agreed interest rate, which is the strike rate, at a future maturity date, meaning when you get the loan. On the date of expire of the option, the buyer must decide whether or not to exercise the right. Borrowers can buy interest rate cap to benefit from rise in interest rate, and lenders buy interest rate floors. Using a collar arrangement, the borrower can buy interest rate cap and at the same time sell interest rate floor, which reduces the cost for the company. Premium is non-refundable and it becomes the maximum loss for not exercising it. You know that. If the option is favorable, it is exercised on a future to make a profit. You get that? Or meaning you buy or sell the option or buy or sell the futures and the difference is profit. I will show you this when I'm saying exercising the option. Normally you exercise the option on a future to make futures more attractive. I will comment on that when I get there. So this is the terminology used. We said there is a call option or a floor, meaning this is for borrowers. I mean for lenders, sorry, because they fix interest rates from falling. That's a floor. A put option or a cap, that's a right to sell. This is called a put option or a cap, is for borrowers. So from this you can now say borrowers buy interest rate put options now and lenders buy interest rate call options now. For what purpose? To secure the right to deal at a specified interest rate. Knowledge of knowing that who buys what is important because it helps you to calculate rightly the premium. You have to calculate correctly the premium. Now, options on interest rate futures. As the name suggests, these are what you are doing is come 3 months, you are choosing whether should I go on options or should I use the futures. This embedment of options with interest rate futures is because interest rate futures, as we have said, they are marked to market daily. So if you are making persistent losses, they become not attractive to you. So to make them attractive, normally they embed to encourage participations in interest rate futures. They may put options on those futures so that you choose when you are closing the futures price. When you are exiting the futures market, you choose, should I deal with what is the closing interest rate or should I go on interest rate on the options? So no wonder why I'm saying this basically involves comparing option strike price to the closing futures price and decide whether or not to exercise the option and then computing the net outcome. Collar on options. So a collar on option, as I have said, it combines both puts and calls. So what happens is how you set up a collar depends on whether you are a borrower or you are a lender. So I have a video where I explained questions on collars because it's not in this handout. So I'm going to send those videos as I have said. You will see it, a video called mentioned there is collar on options. Just play it. I was your say teaching, so it's still fine. So let me just explain. You will notice in that video I was also coming to this very same point over and over. If you are a borrower, borrowers always start by buying interest rate put. This statement should not be claimed or something. You know that a borrower sell to receive. You sell to receive. So it's a put option. So borrowers buy interest rate put option and simultaneously sell call option because there is a caller which they are using. And simultaneously sell call option, thereby paying a net premium. But you need to understand what I mean by buying a put in a collar arrangement. Buying a put means securing the right to sell the interest, to sell the futures at a strike price. Remember, put means right to sell. So when I say buying a put, you are securing the right to sell futures at a strike price. When I say sell call, when I say simultaneously sell call, selling a call means securing the right to buy futures at an option strike. No wonder why we are referring to it as call. And if it's lenders, it's equally the opposite. We say lenders buy interest rate call. That's what they normally do. You start with a call if you are a lender, but you simultaneously sell put, thereby paying or receiving the net premium. So what do I mean by buy interest rate call? I'm simply saying securing the right to buy futures contracts at an option strike price. What do I mean by selling a put? I'm saying securing the right to sell interest rate futures at the option strike price. And these are technical terms. Technical terms. So what I want you to know is I have a video for that. So just a sec so that I fish it out. And the one I want to give you is, let me give the video from Facebook because on that one it is clearly legible. Okay. So what I want to, where do I get it from? Let me get it here. No, it's a matter of searching. You see how I'm searching my profile for videos. The same way you can search, but as a student, the issue is you may then play a video which is no longer compatible with the syllabus. As you can see, I'm adding some of the stuff like quotations of interest rates and stuff. So this is caller. I just want, perhaps if I type caller on options, I will find it. Let me see. Caller on options, yes. I don't want the one on YouTube, but let me take the one which is not on YouTube, which is on Facebook, like this one. Right. So hedging interest rate, caller on options. That's the purpose of this video. So let me copy its link here and share it in our WhatsApp. It's AFM. All right. Okay, let me switch on my. Right. For whatever reason, as you can see, my WhatsApp. Oh, sorry, my Wi-Fi on the phone was off. Right. So I'm sure it's now done. Let me check now. Yeah, okay. Okay, so there you go. Video count 1. So this one is done. I wanted to populate what it is about, taking time to show that message up. Right. You know, if it shows it like this, then it can send nicely. So there you go. So on the caller on options, I'm sorted. I'm sorted on that one. It's now left for you to sort it out. Can you imagine? We are already done with the hedging interest rate risk. Now let us now. There's in that particular video which I've just sent. I also discussed about the use of interest rate swaps. If you don't find those in that video, please let me know so that I can send the video on interest rates. But I'm sure I discussed that towards the end in that particular video. Okay, so let us read the question. Our company is expecting to receive 48,000. So when you see that statement, it means this company is a lender, is not a borrower. It is expecting to receive 48,000 on 1 February 2014, which will be invested until needed on 1 June. So it is going to be invested from 1 February and it will be needed for a large project on 1 June. So the loan is from 1 February to 1 June, which is February, March, April, May. The loan is just for 4 months. The investment, sorry, is just for 4 months. Due to uncertainty in the market, the company is of the opinion that interest rates will fluctuate significantly over the coming months. Although it is difficult to predict whether they will increase or decrease. Our company's treasury team want to hedge the company against adverse movements in interest rates using one of the following derivative products. So they want to hedge either using forward rate agreements or interest rate futures or options on interest rate futures, meaning you have to choose whether to go to option or to sell on a futures market. I will show you shortly. Our company can invest funds at relevant interbank rates less 20 basis points. So what the company receives is the interbank rate less 20 basis points. The current interbank rate is 4.09%. However, our company is of the opinion that interest rate could increase or decrease by as much as 0.9% over the coming months. The following information and quotes provided from an appropriate exchange on dollar futures and options. Margin requirements can be ignored. So there are 3-month futures, meaning these futures mature after every 3 months. So what it means is, okay, I shall show you shortly. Contract size 2 million. Are you not seeing how big the contract sizes are for futures? No wonder why you don't find them in this part of the world, because we normally, companies, they don't have such amounts of monies. These are actual contract. Don't just think you happen to find contract sizes in exams. ACCA exams, they mirror what is obtaining on the ground, though they use hypothetical companies. Prices are quoted in basis, it's discount basis. So you will now understand that these are interest rates. So when you say futures price, in this case, because we are talking of interest rates, we are referring to interest rate quoted on the futures contract. Now, when they say, coming back here, when they say current interbank rate is, it means this is the spot. This is the spot. That's the current interbank rate, is the spot. And then options on 3 months, or again, options have the same contract size, but options, you are being told by the examiner that premiums are in annual percentages. So if you see the premium written like 0.312, it is actually 0.312%. And they are in annual percentages. It means when the option is 3-month option, you have to time apportion these by 3/12. Then Voblaka Bank has offered the following FRA rates to A1: 1 to 7, 3 to 4, 3 to 7. You now understand how we quote FRA rates. You need to know today is what before you can take the appropriate FRA. It can be assumed that settlement for the futures and options contract is at the end of the month, and that basis diminishes to 0 at contract maturity at a constant rate based on the monthly term intervals. Assume that today is 1 November. Okay. Today is 1 November. So today is 1 November. And you are expecting to receive on 1 February. Is you're expecting to receive your money on 1 February and then invest it for 4 months. So between 1 November and 1 February, that's where you are exposed to interest rate. So you're expecting to receive your money and invest it on 1 February, but today is 1 November. So you are going to invest after how many months? November, December, January. November, December, January. So between now and the time you invest is 3 months. And you invest for 4 months, from 1 February to 1 June. So which FRA then captures that? The FRA that captures that is 3 to 7. Remember, 3 to 7 means a 4-month investment to be made in 3 months' time. That's 3 to 7. So examiners, they expect you to be able to know all these things. So all other FRAs are no longer relevant. Required. Imagine the marks allocated. Just imagine the marks allocated. 19 marks. It's a complete question. Based on the 3 hedging choices one company is considering, recommend a hedging strategy for 48 million investment. If interest rates increase by 0.9%, support your answer with appropriate calculation. So let us, there's marking scheme for that, but I want to use this question to explain. So let us answer it. So these are hedging choices available. But before we make use of hedging choices, let us have what I can call a base information. Base information for the company. I always want you to do this as well. This is the base information for A1 from what we are given. What we are given is spot rate. Spot rate. By spot rate, we are saying interbank rate. Interbank rate after 3 months. So the question is, they are saying interbank rate. Actually, before I say after 3 months, let me say spot rate. Let me just say spot rate. But there are two scenarios in the question. They are saying if interest rate increase, you notice this part, if interest rate increase or decrease. So let us accommodate that, the possibilities. If interest rate increase interest rates by 0.9%, and then on the other column, this is increase in interest rate by 0.9%. Here, let us put decrease in interest rate by they are also saying 0.9%. If they give you another percentage, it's not like they should be the same always. No. These are the scenarios that we have. The examiner actually wants us to see the outcomes under these scenarios. So let me bold it and demarcate my answer. This is how you would answer it in the exam in order to save time. Don't answer it in the way the examiner has put it on the marking scheme. Lest you spend 1 hour working on something which is so easy and to the point. All right. So these are the scenarios. Now you have the scenarios. I want just for you to see. So we have got spot rate. Spot rate. Spot rate is 4.9% here. They are telling you that the current spot rate, I quoted this. Oh, sorry, I'm rushing it. The current interbank rate is 4.09%. That's the spot rate. So you just come here and put 4.09%. The spot rate is 4.09%. 4.09%. Here, still is 4.09%. Then following increase / decrease by 0.9%. If it decreases or increases by 0.9%, it becomes, the spot becomes equals this plus 0.9%, right? So it becomes 4.99%. So there you go. Here it becomes, okay, 4.99%. Oh, sorry, 4.99%. Here it becomes equals this minus 0.9%. And what I'm getting, it becomes 3.19%. 3.19%. So there you go. And then what A1 does it, investment rate, we are told that A1 invest funds, investment rate, A1 invest funds at, we are told that A1 invests relevant funds at interbank rate less 20 basis points. So the investment rate for A1 is it will be 3 months, it will be 4.99 minus 20 basis points. It's 4.99% minus 20 basis points, which is 0.2%. Remember, 20 basis points is 0.2%. So investment rate for A1 becomes equals interbank rate minus 0.2%, which is 20 basis points. Here it's again the same, equals interbank rate minus 0.2%. This is the rate at which A1 invest funds. I'm just putting what I'm given by the examiner. It's not like I'm thinking too much. No, I'm yet to evaluate the hedging options, but I'm just. Are you getting it? Then, what else is there? It's investment income. Investment. The investment income becomes what? It becomes either 48 million times 4.79%, because that's what it invests, times 4/12, because the loan is for 4 months. Always know that these are annualized rates. Then the other one is the same, but what you simply say is dash 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 times 2.99% times 4/12 on the other side. So you're simply saying equals 48 million times this rate here times 4/12, because the loan is for 4 months. Here you do the same, equals 48 million times this rate here times 4/12. So there you go. So this is the investment income that A1 will get. With this, I can close now. Then, after I have done, this is just base case information. Without hedging, this is what will happen. It is this outcome that we want to hedge. So we now want to hedge using forward hedge. Forward hedge. Forward rate agreement. Right. So if you hedge using forward rate agreements, what it means is the appropriate FRA to take here, the appropriate forward, we identified it that it's 3 to 7 at 4.82%. So 3 to 7 FRA of 3 to 7 at 4.82%. Is someone asking a question? Can I take it that way? Say, are you sharing your screen? Yes, I am. If you are not seeing it, perhaps it's network, you can exit and join again. For a moment, I thought I wasn't, and that was going to be a disaster. Okay. So you realize that the appropriate FRA is 4 to 7 at 4.82%. You know what it means? Please pay attention to your say. I said what you hedge with a FRA is the interbank rate. You don't hedge this minus 20 basis points. That's not, it's that one is firm specific. You can only hedge the interbank rate. So you as the lender, you had said interbank rate will be 4.82%, yet interbank rate then moved to 4.9%, 4.99. These are now the actual interbank rate. So you can say, you can see here that you fixed a forward, but you lost. It's a loss there because you are a lender. You had said interbank rate forward contract is 4.82, yet it increased to 4.99. So you have lost. So what you simply do is you say investment income. Investment income. This is your investment income that you get. And then you then say loss from forward. Loss. This loss from forward is actually not loss. We put it as payment to the bank, Blacker Bank. Payment to the bank. Why payment? Because you fixed the forward of interbank rate of 4.82, yet it got to 4.99. So payment to V Bank becomes, you then say 48 million times open bracket 4.99% minus 4.82. I told you what you fix in a forward is the interbank rate, not your investment rate. So you then say times 4/12. So what do you get here? You are paying to the bank equals minus 48,123 times open bracket. This rate here, 4.99 minus 4.82, 82%, close bracket here, times 4/12, because it's for 4 months. 27,200 is the payment that you then make to the bank. So there you go. 739,200 becomes the amount that the receipt that you get. You get that? Just checking whether you've done it right. Well, it is too fine. Here, this is called net outcome. Net outcome from the forward. Now, if you come to if interest rates increase to this section here, what is going to happen is, again, you have investment income. You have investment income. It's investment income. It's still, let me broaden it a little bit. Investment income, it is still 478,400, and then you say, notice you had fixed the forward of 4.82 interbank rate. You are a lender, but interbank rate then fell to 3.19, in which case you gain. If interbank rate falls to 3.19, you gain as a lender because the forward was higher than the actual interbank rate. You are a lender. If you were a borrower, you lose. So you say receipt from V Bank, receipt from V Bank. Again, receipt from V Bank, you simply say equals 8 million times open bracket 4.82% minus 3.19% close bracket times 4/12, because these are annualized rates and the loan is for 4 months. So you then have here as equals 48 million times open bracket 4.82% minus this rate here, close bracket, times 4/12, 206. So what will be my net outcome? Net outcome, you add here. You say equals this plus this. So the net outcome is 739,200. So either way, the net outcome is 739,200 because it increased by the same rate or decreased by the same rate. And forward, you lock yourself into the forward. So we can now calculate the effective rate. You can now come here and say effective rate equals effective rate. Effective rate, we are saying what we have done for 3 months. If we repeat it over a year, it will translate into what annualized rate. So effective rate, you find it by saying net outcome outcome over the loan times 12 months, because in a year there are 12 months, over 4, which is the loan period. If the loan period was 3 months, you'd say over 3. This is how you calculate net outcome. So net outcome becomes equals this divided by 48 million times 12 over 4. We are saying what we have obtained in 4 months. If you were to repeat it for the year, how many 4 months are in a year? There are 12 over 4 months. If it was 9 months, you would say 12 over 9. So you get the net outcome of 4.62%. This is your net outcome, 4.62%, and still it is the same figure here because you can tell it's the same rate, 4.62%. The net outcomes are what we then use to compare and get the appropriate hedging choice. So this is forward. Are you not seeing? Look at how succinct is my working. Look at how brief and articulate is it. Imagine if you had followed what the examiner did. Notice what the examiner did just for forward. This is the forward from here through to imagine it's a full page. It's a full page here. So this type of arrangement, I don't encourage it because you won't finish. Just to do them side by side like this. It's easy. It's easy. Even doing side by side, the examiner can tell you are going to know it even if. Now futures hedge. Hedge. Futures. It's actually it's interest rate. Futures hedge. Interest rate futures hedge. Now interest rate futures hedge. It's like this. You are a lender, so lenders buy interest rate futures now. You know that. Lenders buy interest rate futures now. I told you that. But the question that you then have to ask yourself is, which ones, because there are quite a lot of futures contracts there, which ones? December, the March, the June. The issue is, I told you that exposure period is between now and when you get a loan or when you invest. So investment is to be made on 1 November. This time we're not getting a loan, we are going to invest. So we are exposed to interest rates between now, investment is to be made on 1 February. So we are exposed to interest rates between now, which is 1 November, to 1 February. So this is the period you are exposed. So if you are exposed up to 1 February, it means the futures to use are March futures. Because I said you use futures contracts which expire immediately after the exposure period. That's another thing. And what is exposure period? It is not the loan period. Exposure period is the period between now and the time you get a loan or time you invest. This is the period you are exposed to interest rate movements. Once you have invested, you are no longer exposed because you have already signed the contract. So we are going to go by March futures. You now understand. Now that we are going by March futures, do you buy or sell? You are a lender. A lender buys. So that statement is to be written here. First, to say the firm buys, not because it's the firm buys March 2014 interest rate futures contracts now. Interest rate futures contracts now. This statement is important. The firm buys March interest rate futures contracts now. So if we buy March interest rate futures contracts now, how do we go about it? We then say number of contracts. Number of contracts. Number of contracts. Notice now how we calculate number of contracts. When you are calculating number of contracts in a futures hedge, the futures are 3-month futures, yet the loan is for 4 months. Meaning after 3 months, you roll them over. You roll them over. So for that, because you roll them over, number of contracts, we then say 48 million. 48 million, that is the loan, divided by contract size, which is 2 million, times 4 months, which is the loan period, divided by 3 months, which is the futures period. Because futures are for 3 months, loan is for 4 months. So we after 3 months expire, we roll them over, so to speak. So the number of contracts that I'm getting then become equals 48 over 2 million. The contract size is 2 million times 4 over 3. I'm getting 32. So number of contracts are 32 on both ways. And then after getting number of contracts, you then have to have basis in order to estimate closing futures price. You need to have basis. So here is how you calculate basis. Basis is like this. You say basis. I told you what you do. You need the spot price, but spot price is today's price. In futures now, today's price is the spot rate here. It's 4,09. So you write it in futures notation. So you say spot price. You write it in futures notation, 100 minus 4,09. That's discount basis notation. So you get equals 100 minus 4,09. So there you go. This is the spot price. This is the spot again, because the spot is the same on both sides. And then you say March 2014 futures price. March 2014 futures price. By futures price here, we are referring to interest rates. So this is the March 2014 futures price, 94,76. So this is 94,76. 94,76 is the same price here, 94,76. Then this is end of March, and we are talking of from 1 November to end of March. So it's November, December, January, February, March. So the basis we are going to get here are basis for 5 months. The basis that we are going to get here, they are 5-month basis. So you are going to say equals this here minus this. There you go. Here you say it's the same, equals this minus this. There you go. And then you say, so this is 5-month basis. Are you not seeing we are doing the same way we were doing it there with current futures? Then what you then say is an expired basis. Remember, we have 1 February up to 1 February from 1 November. So an expired basis is February and March. I want to use an expired basis. Now I recommend you use an expired basis for interest rate. An expired basis meaning Feb to March. That's an expired basis. So it's simply 2 over 5 multiplied by 1,1,1,15. That's an expired basis. So what you get equals 2 over 5 times this. Notice I'm setting up my futures hedge. 2 over 5 times this is the same unexpired basis on both sides. Now I then say closing futures price. Are you not seeing here that bases are decreasing? The bases are decreasing here. So when you exit the market on 1 February, what will happen? You have closing closing futures price. So what will be the closing futures price? You simply say spot on 1 Feb, on the spot on the day of transaction, spot on 1 Feb as an expired basis, So what it means is, what is the spot on 1 February? The spot on 1 February, it depends. Here it's 4.99. Here it's 3.19. This is what I'm referring to as 1 February. 1 February. So this will be the 1 February interest rate on the date you are now exiting the market. So this is the rate we are now going to use to calculate closing futures price. So it's, you write in discount basis notation, 100 minus 4.99. You just don't say 4.99. Remember, you are in futures markets. 100 minus 4.99 minus an expired basis, which is 0.46. That's how you calculate it. The other one, the spot is 3.19 on the other end. So on the other end, it's 100 minus 3.19, and then take out an expired basis, 0.46. So there you go. You are saying open bracket 100 minus 4.99 close bracket minus an expired basis, so 9.55. Here, what is the closing futures price? You are saying equals open bracket 100 minus spot on 1 February, which is 3.19 close bracket minus an expired basis, which is this. So you get 96.35. Key thing is, when you are calculating closing futures price, when you are saying spot this time, you are saying interbank rate at the date of transaction. Interbank rate at the date of transaction. That's one thing. Another thing you may say, why are you saying less? Less, it's not like it is always said less. Less you see by the general movement of bases, that bases are decreasing from 95 to 94. So bases are decreasing. This is validating less here. If they were increasing, you'd say plus. All right. So there you go. Okay. So once we have done this, we are now saying futures outcome. Futures outcome. Here is how futures outcome will look like. Here you say buying price. You ended by buying, so you say buying price. You bought futures contracts at their price, which is 94.76. That was the price of futures. You exit by selling. Selling price. You exit by selling. So this is closing futures price. That's your selling price. Closing futures price. You exit the market by selling. So you exit with this price. Here you do the same. Buying price was 94.76, and then you exit by selling, which is the closing futures price. Have you made a profit or loss? Just consider these to be actual, consider them as monies. If you buy at 94.76 and you sell at 94.55, clearly you buy at 94.76 and sell at 94.55. This is loss from futures. Loss from futures contracts. This is loss from futures contracts. Remember, this is basis or loss from futures contracts. So you're saying equals. You bought at a high price, you sold at a lower price, so you made a loss 0.21. This is 0.21%. Notice that. Because it's basis, so you have to divide by 100. Was it a loss here? this one, you bought at this and sold at this. This was profit. Here it was profit from futures. So it's profit of, this is per contract, this minus this. So it's 1,59. Remember, it's percent. So you then said investment income. This is what you are going to receive. Had you not hedged, investment income was 766. It is still the same that we have. And we are taking everything from base information. Investment income is this and that. Now, you then realize you made loss from futures contract. You say loss from futures. How do you calculate the loss? This loss is not money, it's interest rate. So you say, how many contracts do you have? You have 32 contracts. Each contract is of how many, of what size? Each contract is of 2 million. And the loss was how much? The loss was 0,0021. I have now put percentage. And the contracts are for how many months? The contracts are for 3 months. 3 over 12. So here I get my loss here. I say equals 32 contracts times 2 million times 0,0021 times 3 over 12. So this is the loss from futures contracts. I put it as negative because it's a loss. Let's say, let me just try to find where I can put negative like this. So I can now add, this is the net outcome. This is net outcome, 732,800. Here, it's profit. Here, remember, I put profit. It's not the loss, profit. This time, profit is 32 times 2 million times 0,0159, because it's 1,59 here, so I'm putting it as a percentage, times 3 over 12. So there you go. So loss from a profit on futures equals 32 contracts times contracts of 2 million. On each contract, I have made a profit of 0,0159 in terms of interest, and this interest is annualized, so I multiply by 3 over 12 because futures contracts are just for 3 months. Right, then I calculate the net outcome as well on futures like this. Yes, we've done this. This is the net outcome. I can now calculate effective rate. And remember, effective rate is calculated the same way I calculated that on forward. Effective rate. You say net outcome over the loan, in this case 48 times months in a year, 12 over the loan period. So it equals to this over 48, 123 times 12 over 4. So effective rate on futures is 4.58%. Here it's the same because we have the same net out. It's not always that we have the same net outcome. The reason why there's coincidence in both ways, it's because the rate of increase is the same as the rate of decrease. If they were different, here, where we were subtracting 0.9%, if they said 0.6 on this one, here 1.1, you'd notice you'd have different outcomes going forward. Okay, so there you go. Right. So you are done with futures, but I want you to see how the examiner would have taken, if you follow the layout in the marking scheme, how you would not finish it like that. I need you to do it side by side. The reason is the marking scheme is like this. I want you to see how long is the answer on futures alone. On futures alone, notice from here using futures. This whole page is on futures. The next page still, so it's like, yes, a full page on futures. So another way we said you buy futures contracts now. Another way of saying it is you go long on March 2014 futures. That's another way of saying buy March 2014 futures. So this one is pretty cool. So there you go. Last but not least, let us wrap it up. Let us wrap it up now using options on interest rate futures. Options on interest rate futures. Are you not seeing I had skimmed everything to end at 4 p.m. exact? This tells you how, to the extent I am confident with this, I want you to understand everything also and be super confident like you say. I've done almost everything that a say can do on this, explaining, giving you the examples, doing everything. Now, options on interest rate futures. That's another. Options on interest rate. Options on interest rate futures. How do you navigate these options on interest rate futures? So it is like this. You are saying come the day you exit the market, which is 1 February, you have a choice either to go to lend money at option interest rate or to lend money at futures interest rate. That is the choice you have. So because you are a lender, which interest rate options do you vie for? Because you are a lender, you need to answer that question. Do you know? I say the borrowers sell because you receive by selling. So you go to put options if you're a borrower. But if you are a lender, you lend money by investing. So or by buying. So you go to core options. And which core options are we talking about? We are talking about match calls. So we are focusing on match calls here. That's what we are focusing on. But there are two strike prices. Here, it's unlike currencies where I said you choose the one which is good for you. Here, you take all of them. You evaluate using all of them. So, two strike prices. So you need now to say the firm buys March 2014 call options now. So this is the very first statement you have to put to say the firm buys March 2014 call options now. This is so important because the examiner already knows that you know the premium to take with this statement. Number of contracts, because there are 3-month contracts again, so you can say number of contracts. You just use what we have done there, which is 32 again here. It's 32 on this side, and then after you have calculated the number of contracts, what you can now do is you have strike price. Notice the strike price for these two for these options, it's 94.5 and 95. 94.5 and 95. So you put them side by side. 94.5 and 95. These are the strike prices. So it's 94.5 and sorry, 94.5 and 95. These are the two strike prices. They are, so you can see them side by side. But remember, it's options on interest rate futures, meaning you have a choice to lend money to these rates or to go to the options. So you need, this is happening on 1 February. So you say closing futures price. Closing futures price. Now, the closing futures price is the price we have calculated above equals, here we calculated it to be 94.55. That's your closing futures price, which is the same. Then on the other end, we calculated closing futures price to be equals, it was 96.35. So there you go, 96.35 and 96.35. Now pay attention on this one. Pay attention on this one. What I'm asking myself is, I then ask myself, do I have to exercise this option? Do I have to exercise it? Notice, remember I am a lender, meaning as a lender I am buying. Let me repeat, remember I am a lender. As a lender I am buying. So I am asking myself, can I buy at 94.5 or can I buy at 94.55? You do notice that it will be ideal to buy at 94.5. Now, if I buy at option strike price, I am said to have exercised the option like this. Can I buy at 95 or can I buy at 94.55? Now, if I go, I can't buy at 95. I would go to the option. So, to the futures. So, because I have not used the option, I say I have not exercised it. The same approach here, I am a lender, so I buy. Now, if you were a borrower, you ask yourself the same question. I am a borrower, so I sell. Can I sell at this or I sell at this? You would notice you would opt here, you do not exercise, but here you would exercise because you sell at 95, which is a higher price, which is the option. But here we are lenders here. So we buy. Can I buy at 94.5 or 96.35? I would buy at 94.5. So I go, if I use the option price, I say I am said to have exercised it. Can I buy at 95 or buy at 96.35? Still, I buy at option because it's cheaper. So having done this like what I have done now, I need now to calculate profit from options. Profit from options. Profit from option here, it's a matter of saying this minus this. But when I don't exercise the option, there is no profit from option, not applicable. Here, this minus this. 1.85. These are interest rates. 1.35. So it's when you are punching in the calculator, it's actually 0.0185 and 0.135. Once I have done this, I then say options outcome. Options outcome. This is not actually options outcome. It's options on interest rate outcome, on interest rate futures outcome. Options on interest rate futures outcome. Let me see now how the outcome will look like. So this is I have hedged, so I have made this profit. So what I can simply do is I then say I just say investment income. Investment income is still the same. Here it's this figure here that we calculated from base information. This is the same investment income that I have here. Here the investment income is this one, the same here. All right. Now I have my investment incomes. So what do I do next? I then say profit from options. Profit from options. Now I do it like this. When I'm working profit on this part, I say how many contracts? 32. Each contract is 2 million. I made a profit of 0.05%, so it's 0.0005 times 3/12, because these are 3-month options. So I then say equals 32 times 2 million times 0.0005 times 3/12. So there you go. Here there's no profit. So on this one, I still do the same to say 32 times 2 million times 0.0185 times 3/12. So there you go. So you say equals 32 times 2, 1, 2, 3, 1, 2, 3 times 0.0185 times 3/12. So you have the profit from options. So you can still do the same here. You can still do the same. Instead here you say 0.135, 135, and then you still do the same equals over 12 here. You get that? Okay. So you say copy. Let me paste there. It's good. Now I just want to put 35 there. 3 here. So you now have your net outcomes. Your net outcomes. So there you go. This is your net outcome. You drag it. Your net outcome. That's your net outcome. Why are the figures the same? It's because, but you notice on this one it's different on this one because of the premiums. Now you calculate effective rate. Effective rate. Effective rate, still have that. So it's effective rate, it's a matter of saying equals this divided by 48 million times 12 over loan period 4. So that's your effective rates. So there you go. Okay, you put your effective rates as percentages. It's nice to put them as percentages. Right. So you can check whether these were the answers they got as effective rate. Were they the answers which the examiner got? Just to verify on options. So are you getting it? Effective rate 4.41, 4.67. Those on the right. 4, yeah, I'm getting 4.84, 4, let me see, where did we get it from? Oh, okay, sorry for that. Sorry for that. I don't know why nobody from the class failed to remind, say that you have left premium. You have left premium, because when it's an option, remember there is premium. So you come here and say premium. This is paid at the beginning. So premium. Now for premiums, what you do is you go to the table. For premiums, you go to the table here. Here are your premiums. June, remember we said March calls. So at a strike price of 94, it's 0.432%. At a strike price of 95, it's 0.121%. So You may say, where are you getting the percent? They tell you that options premiums are in annual percentages. You'll be told. No wonder what, but these are 3 months, so you have to multiply by 3/12 because these are annualized rates. So here is the premium. There are 2 premiums that we have to calculate. So you say at 94.5, what is the premium? Remember, you have 32 contracts times 2 million times the premium at 94.35 is 0.432, but you put it as a percentage, so it becomes 0.00432 times 3/12. That's your premium there. So you come here and say equals 32 times 2 million times 0.00432 times 3/12. That's your premium. Because it's a premium, it's a payment, you are receiving money, so this one negative. If you were a borrower, a premium would be added, but because you are a lender, you are receiving interest, so a premium is deducted. Then you say at 5, what is the premium? 895. Okay, you can do it like this and say 895. 895. 32 times 0.121 here. 121, because 895 the premium is 0.121. So there you go. So I can equally say copy here and bring it here and say paste, and then just say 0.121 here. 121. So these are the premiums, and these are the same premiums here. They don't change. These are the same premiums here. Equals this, and then it means your net outcomes there then equals sum of all this, then close bracket, enter. You can see now that the effective rates are now what we have in the exam here. It is the effective rate that you use for marking. Once you get your effective rates right, that's it. So effective rates on options 4.14, 4.67, and the other ones are 4.41, 4.22, which is exactly what we have these rates in the last line here. So this is the net outcome. Net outcome, you get that? Okay, so we check also effective rates on futures, just to verify that when you are playing the video, I have not made a typo or anything of that sort. Effective rates on futures, we got them as 4.58. I mean, the examiner has them as 4.58. We equally got them as 4.58. So it's correct. Everything we've done there. Effective rates on forwards. Effective rates on forwards is 4.62. We calculated, we got it as 4.62. 4.62, which is correct. Now, you may say, what is the significance of effective rates? If you are lending money, you'd go with the option with the highest effective rate. That is the option which is paying you more. So from what we've calculated, you can see that the forward here is the highest effective rate. That's what you then recommend. Any other, all the others have lowest effective rates, have low effective rates compared to forward. Now you may say, containing options, there is also an option with a higher effective rate, this one. But this higher effective rate arises after we have not exercised the option. So you can compare, you can comment and say the hedging method which is appropriate is to use forward, which has got overall high effective rates. However, if interest rate increased by 0.9%, interest rate, options on interest rate futures at a strike price of 95 would give the highest effective rate. Just to comment like that. If you were a borrower, you would use the option with the lowest effective rate. And as you are a lender, you noticed that premium is subtracted from interest received because premium is an expense. But if you are a borrower, premium will be added because a borrower interest is a payment, a premium is a payment, so they are like terms. So you can as well proceed like that. I must admit, what I have said, there's some technical stuff involved, but you have to replay the videos and understand it. I have now sent the video on color on options. You can go ahead and play that. So clearly, there are a lot of other stuff that we cover during revision, but overall, our syllabus is up. There's really nothing more to discuss apart from revision. So this August, we are no longer going to discuss technical content again. Like to teach you what is this again. We are now going to do past papers. It is application of technical content which matters. It is that application and communicating it with the examiner where students fall short. And it is that which is going to be the main focus of our revision. And as I have said earlier, don't expect a revision where we will just have it on Wednesday. I expect me asking your colleagues in the group, is anyone free, so that we can just do a question paper just for an hour, a question for an hour. And then the rest you can as well record, in addition to our usual Wednesday time slot. On that note, I'm sure you appreciate, as you say, I've been talking non-stop for close to 4 hours. Have you ever done such a thing? So allow me now to have some a glass of water. Cheers, guys. Bye. So I'm sure you enjoyed quite a lot. You enjoyed quite a lot on what we discussed in our first session. I appreciate it was so technical. I need to acknowledge that. But when we then did questions, I'm sure you were now saying, what was the fuss about? Current, futures, options. It appears the hedge setup just zeros to just 3 or 4 lines, and you have your answer. But to get there, there's a lot of technical stuff involved. And you realized also that concerning that topic, examiners also are fond, they like some discursive aspects. And I pointed out to you that they are a major source of easy marks. You realized how we were getting easy marks. And clearly, I don't expect you to understand this past video and this video in a single lecture. You need to play it whenever you are thinking of derivatives, you are thinking of what these are the videos you have to be playing, plus the other ones I'm going to send containing explanations of other past exam questions. Okay, now let us take it a little bit further. Let us now discuss